Hello, this is Jordan, and this video is being recorded on the evening of Wednesday, June 8th, 2016. Thank you for tuning in. And in this video, I'm going to talk about the strategy in terms of investing in gold stocks and junior gold stocks, the strategy of quality versus optionality. And I've borrowed some of these ideas from Joe Mazumdar. He's an analyst that is the co-editor of Brent Cook's publication Exploration Insights. You can go to my website, thedailygold.com. I recently interviewed Joe. He did a presentation regarding this strategy at the Metals Investor Forum, and that's also available on YouTube. And I'm gonna talk about that and put a little bit of my own spin on it. And so really when you're looking at most juniors, they can really fall under one of these two categories. I mean, there's some that might be a little different, but for the most part, most companies fall under one of these two strategies: quality versus optionality. I mean, optionality has kind of been a buzzword lately. Another word there is leverage. That's the word that Joe uses. But in terms of quality, we're looking at assets that are quality, of course, and these are assets that larger companies and major companies are likely to acquire in the months, quarters, and years ahead, given the macro fundamentals in the gold mining space, which we talked about in another video. And if you look at the pipelines for major companies and the projects that they have in the pipeline, their pipelines are going to start to dwindle in the next 4, 5, 6 years or so. Really start to dwindle then. And if you look at the industry over the last 15 years or so, a huge amount of money was put into the ground, spent looking for to find more quality deposits, and it just didn't happen. If you compare what's been found recently to what was found in the 80s, 70s, 80s, 90s, really not that much has been found. So major companies and larger gold companies are going to have no choice, but they're going to have to acquire quality deposits to rebuild their pipelines and replace the reserves that are currently being mined. And we've already seen some, I wouldn't say major takeovers, but just looking at the junior space, we've already seen, I think, 5 or 6 companies in their deposits being acquired. Earlier today, the latest was Fortuna Silver. You could call it a mid-tier silver company. They acquired Gold Rock Mines, who has a deposit in Argentina. And if you got into Gold Rock Mines, not only recently, but 4, 5, 6 months ago, you made a ton of money on that. So that's one strategy, quality. The other one is, we can call it optionality or leverage. And what you're looking for there is something that is going to have a lot more value at a higher gold price. And as far as the specifics of what you want to look for inside of each of these strategies, I'm going to get to in the next couple slides. So next, this is very simplistic as far as a quality deposit. What acquirers really want, especially when you're looking at major companies, what they really want is something that has size and margin. Now, as far as size, when you're looking at something, you want it to be able to produce at least 100,000 ounces a year for 10 years. That's kind of the minimum baseline. Now, if something can produce 50 or 70,000 ounces a year and it's a really good deposit, maybe that will be acquired, but it'll probably be acquired by a company that's not too large of a company. So, but generally speaking, look for something that can produce 100,000 ounces of gold a year for 10 years. And in terms of size and how much gold is in the ground, majors are really looking for deposits that have 3 to 5 million ounces. That's kind of the minimum that majors are looking for. But if you have something that can produce, Gold Rock Mines, that's a good example. I just looked at it, 110,000 ounces a year, proven and probable reserves of about 1.7 million ounces of gold. So, not huge by major standards, but it was acquired by Fortuna Silver, who can be considered, I think, a mid-tier silver producer. It's not a mid-tier gold producer. But you get my point. You get my point of what you should look for. And with margin, it's not just grade. I mean, grade is obviously the most important thing, but at the end of the day, it really comes down to margin. Now, for example, something with really good grade, if there's problems with the metallurgy and recovering the high grade gold there, it's going to cost more to recover. And also, if to mine that gold, if you have to mine a lot of waste to get to the gold, that's going to raise the price. So we're just giving some examples there of why you can't just look at something with the highest grade. And at the same time, something with okay grade or kind of medium grade, if that has really good recoveries and it's really cheap to mine and there's not a lot of dilution there, I mean, the margin on that can be really good. So those are also the things that you have to consider. But when looking at quality assets, size and margin are really the key. And another thing I'll add is jurisdiction, while important, relatively speaking, when you're comparing quality versus optionality, jurisdiction is a lot less important when looking at quality assets, because if something is really good and it's in, I don't want to say a shitty jurisdiction, but if it's in a below average or not great jurisdiction, but it's a really good asset, companies are still likely to go after that. So those are some things to keep in mind as far as the quality strategy. Now, next, let's talk about the optionality or leverage strategy. Now, with respect to size, something that is much bigger has a lot more leverage, obviously. So, for example, something that is marginal that has 1 million ounces of gold, we don't really care about that. It's too small. Now, something that's marginal that has 5 or 6 million ounces of gold, if it's marginal now and it's in the money when gold goes to 14, 1500, that I mean that is, I mean, there's a lot of optionality there. There's a lot of leverage potential versus if something is small and only has 1 or 2 million ounces. So you want to look for with respect to gold in the ground in these deposits, you want to look for something that's really big. Jurisdiction is a lot more important, because if something is a marginal asset and it's in a poor or below average or even average jurisdiction, it's going to attract much less attention. So stick to the good jurisdictions here. Or I mean, if something's average, I mean, obviously it depends on all the factors, but jurisdiction is more important here than with respect to looking for quality assets. So just keep that in mind. Now, let's talk about cash and capital structure. As Joe said, you want to make sure the company has enough cash to keep the option alive. And if a company has a lot of cash and the share structure is not blown out, then that stock is going to be more likely to move quickly. One stock that's happened with, I'll just give an example, is Bear Creek Mining. And it's also a reason why Bear Creek got killed in the bear market. I mean, I haven't looked at their presentation recently, but um, when I was when I've been covering it in the last couple years, I mean, I always noted it's a very tightly held stock. I mean, there are 4 or 5 hands or groups that held 50 or 60% of the stock. And now it hurt the stock on the way down, but look what's happened on the way up. So with respect to cash and capital structure, that's just one example of something's really tightly held. That's a positive. And also look at, what is the strike price, so to speak. I mean, what price is this asset going to be in the money? Is it 1600? Is it 1400? I mean, personally, I like to look for things that, I mean, obviously gold is 1260 now. I mean, I like to look at things that are 1350, 1400, that kind of strike price, so to speak, because gold has upside targets at 1375 to 1400. That's if it breaks 1300. And then if it breaks 1375 to 1400, 1550 could, I mean, that is the next target. So, I mean, perhaps gold could rally to 1550 in the next 9 to 12 months before there's some kind of significant multi-month pullback. And in that scenario, if the the strike price is 1350 or 1400 or even 1300, that option is suddenly going to become worth a lot more if the gold price moves to those levels I was talking about. So that's something to keep in mind. And also potential. You have to look at how much something has moved. I mean, obviously, I talked about Bear Creek. That's moved a lot, but in my view, that still has some potential. But obviously, the potential is not as great as it was 5 months ago or even 2 or 3 months ago. So keep that in mind, um, and keep all these things in mind, to be honest. I think I've covered everything here that I intended to cover. Yes, I did. Well, if you want to follow more of my work, go to thedailygold.com. Again, you can opt in there, get my book for free, and you can also get my free weekly newsletter for free. That's the best way to follow my work. I also have a premium service, thedailygold.com/premium. You can find out more about it there. And thank you for taking the time, everyone, to listen and watch my video. Hope you liked it. Hope you learned something. And I look forward to doing another video for you in the next week or two. Thanks.